This is AHA Business Radio, creating aha moments for business, by business, and about business, providing opportunities to discover information to help you run your business and guide your decision making. The more you know, the better decisions you make.
In order to market the business, you want it to get in front of all and only the right people, right? So you can't just publicize it and run ads in the newspaper, but on the other side, you've got to make sure that it reaches the buying audience. So we prepare a set of documents that can be used for that. The one document is set of documents is called a non-disclosing business outline, which is a mouthful, and all it means is it's enough information about the seller's business that somebody, a buyer looking at it, could get a flavor for the business, understand what it does, understand what its financial dynamics are, but not so much as to reveal the identity of the business itself.
I myself would call that an executive summary of what the full package would be without identifying the buyer, so that the seller, so that the buyer can see if the value is there that you're trying to get for the business, so that the information, but that again is confidential before you go to the next step.
Right. The words in the document are the executive or summary. There are also financial elements in there, assets, liabilities, revenue, net income, and then something we call seller's discretionary cash flow, which is really that cash is king in this business, and the seller's discretionary cash flow is the cash that's generated by the business before the owner gives himself perks and does all those kinds of things.
So the kinds of things where you have an automobile that's not necessarily needed for the business,
not necessarily,
or an airplane, or all kinds of things that you're using the business to help fund and finance your personal life.
Yeah, your 3 college kids that are on the payroll, for example. No, that's. Those have to be added back to the business in order to develop seller's discretionary cash.
So in developing the documents, how far back would you normally go to develop a history for the prospective buyers? And will you ultimately do projections that might be helpful to the buyer?
Right. We always go back 3 years of tax returns, and we use tax returns because those are public documents. We don't work off of a second set of books or anything like that. What you report to the government is what we value the business based on, right? 3 years of tax returns, your current year financial statement. We help you project that current year financial statement through the end of the current year, and then we get projections for the next 3 years after that. So basically, there are 7 years worth of financial information, 3 historical, 1 current, and 3 future.
And then qualifying prospective buyers for the sellers. So once you've qualified the buyers, what are the next steps you do?
Well, after we've qualified the buyer, then we know at least that they have enough money to buy the business if they remain interested. So we get them to sign a rather substantially restrictive confidentiality agreement in order for us to show them and share with them the confidential memorandum, which, as I said before, is really a description of everything that we know about the business, its market, its way of doing business, its structure, et cetera. So when they look at the confidential memorandum, they can decide if they're still interested. If they are, then we introduce them to the seller.
They're making an offer. In what kind of form is that usually done?
Well, a lot of people use letters of intent, and letters of intent typically bind the seller but not the buyer. We do something that's more formal. It's called an offer to purchase, and it's binding on the buyer as well as the seller. The offer to purchase includes the purchase price, the terms, what's included, what's excluded. It also includes a whole bunch of dates that the buyer has to meet, or else the seller can walk away. Things like how long they have to get financing, how long they have to complete their due diligence, those kinds of things that don't allow the buyer to hang the seller up waiting for them to complete.
Assume there are some contingencies involved in that when someone's doing the due diligence, they're to make sure that the seller's representations are correct. Are there outs for the buyer based on certain representations?
Yes, of course there are. There are two different aspects to due diligence. One is the physical aspect, meaning that the buyer gets to inspect the seller's facility to make sure that it's in working order, to make sure that there are no issues with it. Another part of that is examining their inventory to make sure that it's not obsolete, that it's not broken or otherwise impaired. The financial aspect of due diligence is actually looking at the seller's books and records to make sure that the numbers that appear in the valuation documents and the other financial documents that they're relying on are legitimate, that these transactions actually took place, that the assets really are there, and that the cash flow, the seller's discretionary cash flow, is as was represented in the documents.
So if they're not, if what is represented is not accurate and they find discrepancy, they can either renegotiate or the buyer has an opportunity to get out.